Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. I've been preparing and recording this podcast late on a Friday evening. It was a wild week of earnings on Sens, and frankly, something had to give. I have an Uber Eats order en route, as it is the easiest solution, and frankly, I've earned it this week. And therein lies the food delivery model. I am very happy here to pay a premium for convenience. Once I've factored in my travel cost and especially my investment of time to actually go and get my food and then drive home again, in fact, there's no premium at all. There's actually a measurable return on investment by ordering through the platform. My situation is far from unique. The world is full of busy people, often with all the adults in the household working challenging jobs. There are fewer kids running around on average, so there is less of an incentive for these big home-cooked meals with lots of leftovers that so many of us grew up with. As a once or twice a week solution for families with disposable income, ordering food on a delivery platform like Uber Eats works really well. Sure, you can pay less by ordering directly from the restaurant, but I've had enough bad experiences that I've given that up. The friction is not worth the saving. Speaking of the saving, there's an argument to be made that if delivery costs become more efficient, order frequency will go up because it becomes more affordable. The ultimate loser here is actually your local grocery store, as the use of technology makes it easier to connect you to your favorite local restaurant, and that means that grocery stores are having to continuously compete with ready-made offerings. Restaurants will essentially get a higher share of wallet over time, and more delivery jobs will be created in the process. Consumers win, and they want to win in this space, as on-demand grocery has shown us that consumers are hungry for many things, but they are especially hungry for convenience. Now, I have a long position in Uber in my portfolio, mainly because I believe strongly in the increased frequency of users over time across their mobility and food offerings. In other words, people using the platform more and more. Uber Eats, as part of the larger offering, benefits from the economics of that broader Uber platform. With a shared customer acquisition cost and one technology platform at the center of all of this that deals with maps and payments and more. If you understand how platforms scale and eventually unleash free cash flows, then you'll see the opportunity here of adding product verticals to the Uber tech stack. So the key is that Uber Eats would not be nearly as attractive if it was a standalone business. It works well as part of the Uber stable and makes the whole ecosystem more valuable. Pure play food delivery has not had a great time of things in the post-pandemic world. DoorDash, that IPO'd in 2020 at $102 per share. The stock opened up at $182 per share that day in a red-hot market. Today it's at $196. Yes, it's above its IPO price, but it was far below its IPO price from late 2021 until January this year. It's taken 5 years just to get back there. Delivery Hero, listed in 2017, so this was a pre-pandemic business. The issue price, €25.50. They had a tremendous time in the pandemic. The share price nearly reached €140. Sadly, it's now all the way back down at €28, slightly above the IPO price. This is the thing with growth stocks. Timing the market is important. Much of the criticism that was leveled against the previous management of Prosus was based on the timing of capital deployment, with deals done at what were quite obviously frothy valuations. You don't need hindsight for that, you just needed common sense. So if the timing of deals was the issue, then why did the market have such an adverse reaction to the news of the Just Eat Takeaway.com acquisition by Prosus at a depressed point in the cycle where Just Eat has been trading at roughly 90% off its pandemic highs? Is the South African market just so browbeaten and focused on value rather than growth investing that it's just too hard to actually see the opportunity here? Or are there valid concerns about the deal? Before I continue, this is a good time to mention that I bought shares in Prosus in mid-January this year when the market dished up an incredible gift in the form of a very strange sell-off in the share price. I'm still long after the announcement of this deal, and I intend to stay long with my position in the green and by quite some margin. In the year 2000, the dot-com bubble burst, and it gave investors a multi-year opportunity to wave the "I told you so" finger at anyone who dares to invest in growth stocks. At around the same time, a company called Takeaway.com was launched by a student in the Netherlands. Jitse Groen financed it using student loans and a solid hustle, rather than via venture capitalists and fancy listings. In 2003, he ditched his studies to focus on building the company. That was a good trade. Of course, the big capital raises eventually came. The group IPO'd in 2016 and subsequently acquired Just Eat a few years later. This came after selling its UK business to Just Eat shortly after the IPO, so perhaps they missed some British cuisine in subsequent years. 2020 saw another flurry of deals, including the disastrous acquisition of US-based Grubhub for $7.3 billion. They only got out of that mess recently, literally in the past few months, at a disposal price of $650 million, locking in a gigantic loss. The buyer is Wonder Group, and Just Eat Takeaway shareholders must be wondering how so much value was destroyed in that Grubhub deal. The pandemic period also saw another milestone deal for Just Eat, the disposal of 33% in iFood to Prosus. The stake had come into the merged group when Just Eat and Takeaway came together, and this of course led to them crossing paths with none other than Fabrizio Bluisi, current Prosus CEO and the founder who scaled iFood. The rest, as they always say, is history. Prosus has swooped in on Just Eat Takeaway at a time when its share prices had a terrible experience in the aftermath of the pandemic and of course that awful US investment. That is a very different approach to deploying capital at the top of the cycle, which was the old criticism at Prosus. Now that's a fun history lesson, but we are certainly no closer to understanding the negative local market reaction. Europe is not South America, and here it comes, the problem, or at least the valid concern. The big difference between South America and Europe lies in the relative growth rates. If you want to see an example of the opportunities available in South America, just look at the likes of Mercado Libre to see what can be built there. That is one of the best growth companies in the world, with an excellent ecosystem of e-commerce and fintech. Europe, on the other hand, has earned itself a reputation for being a region of regulation, not innovation. They are known for squashing growth, not encouraging it. In 2024, Just Eat Takeaway managed only 2% growth in gross transaction value, excluding North America. It is really tough out there for them, which is why they've been taking steps to simplify the group, including ceasing operations in New Zealand and France in 2024. To give you a sense of what it all looks like going forward, they generate around 85% of their transaction value in the Europe, UK and Ireland segments. The rest sits in the rest of the world, which in their life is actually only Australia, Canada and Israel. Again, none of those are high growth opportunities. These are all developed markets. Now, we can deal with the arguments around market maturity later. In the meantime, we need to raise a point that cannot be disputed. The operating environments are very different. Labor costs in Europe are much higher than they are in South America. Regulators behave differently. Levels of competition are different. We've seen many examples of South African management teams with great emerging markets experience who end up getting a proper clap in developed markets. Not everyone travels to Europe as effectively as the Springboks. Bluisi certainly is not a local retail executive with grand ambitions, but the point around risks across regions still stands. These places are not the same. So can they turn a stagnant market into a growth market? On the recent Just Eat Takeaway earnings call, which happened after the announcement of the Prosus deal, the founder of that business was asked why things will be better going forwards. In other words, what can they do with Prosus to drive growth that they couldn't do alone? To be blunt, I thought the answer was quite weak. It was an incoherent attempt to explain that they need to invest in growth and increase order frequency. They had some additional points around how you can do different things in a private environment versus a public environment. It was all a bit weird, making it sound like more than anything else they need the balance sheet that Prosus brings. Now, the Just Eat Takeaway management team will be sticking around, at least for now, so they really need to start singing off the same hymn sheet as Prosus. That's because Bluisi has a much better answer for why this deal is happening. It all comes down to the technology that Prosus has in its other food delivery businesses, specifically iFood. He disagrees that European markets are more mature. He believes that if you take the opportunity to use technology to reduce delivery costs over time, you increase order frequency and you turn it into a growth market. So the synergies here are not really financial in nature. This is not a cost-cutting exercise in the traditional sense. It's an automation exercise driven by AI and focused on improving the unit economics by making people use the platform more and more and by making it more efficient. Given Bluisi's track record, I am willing to continue to believe in what he is doing. He's not making statements like these lightly. He knows the market will hold him to account and will want to see regular reporting on how things are developing at Just Eat Takeaway. Never mind his financial situation, his reputation is being staked on this deal. With a 12.5 times adjusted EBITDA multiple applicable to this deal, it's a pretty meaty price, but it's nowhere near the utterly ridiculous levels we've seen before in the US. Just prepare yourself for a potentially tricky ride with European regulators to get the deal across the line, particularly as Prosus has a significant minority stake in competitor Delivery Hero. There are some big markets in Europe with overlap between the two, and regulators are certainly going to have a proper look at that. But as we move into the future, this is certainly going to be a really interesting story to follow because it's going to show so much about the approach that Prosus will be taking with deals going forwards. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.